Hello and welcome to this week's episode of Nucleus Investment Insights. Today, it seems markets are no longer that expensive. However, we're going to explore the question of whether this is the time to buy in the context of current and future earnings. First on the agenda, we'll do a valuation overview. Next, we'll look at global fiscal and monetary policy. Then we'll do a quick tour of major economies of the world. So firstly, we'll look at the European economy, looking at the war and energy, followed by China, analysing their property bust and COVID. And of course, we'll look at the US economy and the actions of the Fed. Lastly, as always, we'll cover the investment implications for markets at the end. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hey, how you going?
Good, thanks. Damo. Today, as also, we have an equally integral part of the team, our Chief Strategist, David Llewellyn-Smith.
G'day, Sam. Nice to be
here. G'day, Dave. Excellent. Good to hear. So thanks for that, gentlemen. Just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. One other thing I just want to let you know about is you can download today's slides from our website at nucleuswealth.com/webinars. We generally put them up this afternoon, so feel free to download them at your leisure if you want to have a closer look at the slides. So now we've got that housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you to lead us away.
Yeah, sure. So what I thought I'd do is sort of, as I said, just go quickly through some of the valuation side of it, and then we'll jump into some of the macro stuff behind that, which I think is where the most important side of the debate is. But I just wanted to sort of throw a chart up of the S&P 500 and the ASX 100. So just looking at the price to earnings ratios of those. So you can sort of see that we spent most of the last decade in that sort of 16 to 18 times range for the US, and a little bit lower than that for Australia. And then COVID hits, and we get all this money thrown at everyone, and some quite strong earnings growth as well. And so PEs sort of jump into the 20s for the S&P, and with just this last little bit, you can sort of see that that's come back, and it's sort of back below that 18 level, back into sort of more, the upper end of the range that it traded at for the past 10 years, but certainly out of that ultra expensive range that we've sort of seen it sitting in for the last few years. So it's worth sort of digging a little bit deeper into that, though, because I've got another chart sort of that just takes the two parts, just looks at the price for the S&P 500 and then separates out the earnings, because the reason why is that what we're more interested in price rises that are backed up by earnings. So if we can see the earnings coming through as well, then that's actually what helps to justify the price of the market. And if you look back at, I'll put another one sort of titled Exuberance or Prescience for price to earnings ratios. And what you can see on this one is that there was some pretty high price to earnings ratios in the early 2000s. But that actually just was that occurred, and then we saw this really high growth rates, and so the valuations came down, not because prices came down, but because the earnings boomed away underneath, and so you sort of captured that the markets became cheaper because the earnings fundamentals were improving. And then a similar thing post 2008, and then another one in sort of 2017 when we saw the Trump tax cuts come through, and then finally this last batch. And so I guess the one thing I always like to sort of highlight is that valuation is important, and I've got a couple of charts on this next one sort of showing that prices, it does matter. Evaluation, it does affect your price. There's a bit of a negative correlation if you buy when you buy something that's too expensive. But on the flip side, there's actually this really positive skew when you look at subsequent earnings growth. And so it's about trying to say, well, how much earnings growth is priced in? Is that a reasonable amount of earnings growth or not? And then from there, working out what the price to earnings ratio should be. So I guess where I'm getting to on that is that sort of summed up by this final chart, which is looking at analyst revisions, is that we've sort of set with this huge tailwind for the last 3 or 4 years, where analyst earnings just get continually upgraded and upgraded and upgraded. That's come to an end. And the real question for markets now is, will that become a headwind due to the macroeconomics, or is it going to reverse or stay where it is and continue to be a positive for markets? And so so depending upon what your view is on that, will affect whether you want to be buying at the moment. And so with that, one other thing I wanted to jump in before we get to the macro side. Is just a little bit of disaggregation. So with earnings, there's a number of things going on. One of the things is, you're looking at this growth rate from your first year to your second year. So as we go forward over the next year, there's a growth rate that's already priced in, and then there's going to be revisions in that growth rate. So let's say right now we're looking at the 2022 to 2023 year. So there's going to be a growth that's already factored in, which is about 10%. That's going to be revised upwards or downwards. And then we've also got a surprise in terms of what happens to the 2022 year numbers. Do they come in stronger than expected or weaker than expected? And then if you add in the change in the valuation multiple, and that sort of gives you the net effect of all 4 of those sort of adds up to the change in the price. And so I've got a couple of charts just sort of decomposing that. And so you can sort of see each year where that comes from. So so if you're looking at, say, the 2021 year I've got in there, we can see that the prices, and this is a year to 30th of April, prices are up 44%. Earnings actually came in worse than expected. So they were like 13% lower, but growth rates, they're expected to grow by 25%. And there were revisions, another 21% of revisions, and then the multiple itself expanded. So the price to earnings ratio multiple, and so it was sort of like everything all worked together got you to that 44%. Over the last year, prices haven't moved in that year. They're down 1%, and almost all of that's come from the falling multiples though. So there's been a little bit of earnings surprise. We've had growth, and there have been some revisions, but that fall in the multiple is what's really done it over that time frame. And so when you see these sort of then looked at it in a different direction, you can I've got another chart which sort of breaks them, and rather than looking at it by year, it sort of breaks them into each component over the last 5 years. You can see that most of it is this forecast growth that's sort of already forecast in, and then earnings surprise tends to come in under what analysts are expecting. That wasn't the case for the last year. And so, that's what's really going to drive this going forward is that whole earnings part, especially given the PE has sort of come back in and is sitting at relatively high levels. Does that all make sense, Sam? We've gone through that too quickly. Maybe we jump to jump into some of the macro side, Dave. Hand over to you.
Sure. So, taking out of Damo's little presentation, we basically need to assess where earnings are going. If we're going to decide whether things are priced appropriately now and a good time to buy, or cheap or expensive. So the first stuff I want to just throw up is we're all going to be very aware that there's been both fiscal and monetary tightening globally for the last, it's been running in emerging markets for about 18 months and even 2 years, and in the last kind of 6 or so in developed markets. And so I threw a chart up here for what it's basically a nice aggregated index called the Financial Conditions Index from Goldman Sachs. which just looks at, a million different variables in the fiscal and monetary context, and comes up with an index that gives you some sense of whether the aggregate outcome is tight, loose, or in between. And you can see globally, if you remove Russia, because Russia really inflates these charts quite a bit because it's been hit so hard by the war. But if you exclude Russia, you can see that the globe is already in a relatively tight monetary condition, which will, all things equal, slow it down before too long.
And I think, Dave, it's right to say that the change is pretty important in this one as well, isn't it?
Yes.
That that sudden spike in it is large, is as much the issue as is where it actually ends up.
Absolutely. So, it's happened very swiftly, and that's going to indicate various things. I mean, we've seen, a hell of a sell-off in treasuries, now big sell-offs in stocks, and spreads widening across the private sector as well. And, some pretty wild exchange rate moves, especially in the US dollar, also with big tightening implications. So, yes, the speed of that is going to have very much swifter implications for global growth than most people care to admit. At the moment, the consensus is that if the Fed tightens for another, gets to maybe 3.5% some point next year, then we might have a recession going into 2024. And what this chart is telling you is that we're more likely to have a recession in the second half of this year than 2024. So, because it's all moving so swiftly. So if we flip over to have a look at some of Goldman's nowcasting indexes for growth, you can see that this tightening is already having a pretty good big effect. If I just flip over to the second chart first, you can see that emerging markets, which, as I said, have been tightening for a bit longer, are really diving, like as a group in terms of growth driving. This is very recessionary in terms of their potential growth already, and developed markets have come off a lot this year too, and are sliding at the same time. So at this point, the Goldman nowcasting model is already kind of indicating pretty close to a global recession, which is anything under about 2%. But it's trending down pretty sharply as well. If you want to flip back one chart, you can see that what's driven that today has been China mostly, but Europe has also been hit very hard by the war and the energy shock. Russia, of course, has dived too, but also, the US has started to slow pretty dramatically as well. So all of that tightening that we're seeing in the first chart is playing out in slowing in real economic activity in real time right in front of us. And so we've been pointing to this now for probably, I don't know, a while, 3 to 6 months. Not all of these factors, but certainly the last 3 months. And, we parse this as 6 shocks hitting the global economy all at once. As mentioned, it's clear that Europe has been leading the developed economy slowdown, and the reason for that is the war and energy shock. Huge gas price surges, have hit both utility bills and a lot of industry. They're unresolved at this stage. Certainly prices have come off the extreme highs, but still going. Consumer confidence is way down. The ZEW is way down. Fiscal will help eventually, but it's going to be too lagged because that's just the way Europe works. So in addition to that, the ECB looks ready to start lifting interest rates, and we don't have it here today, but if you look at that financial condition index specifically for Europe, it's already in quite a tight condition, and the ECB is about to hike rates as well. So, Europe's already in trouble and is about to limit credit even more. So, things aren't looking too good for Europe. So that's the first two shocks: war and energy. Second two, we've been talking about the property bust in China for well over a year. It's gotten far worse than anyone, with perhaps the exception of us, has expected, and it's now kind of interplaying with the Omicron outbreak to make it very difficult for China to turn its economy around. So we know that the Chinese economy is in a pretty severe state of lockdown. Maybe a quarter of it has some form of either limits to mobility or more severe lockdown state to try and get rid of Omicron, and that is interacting with the property bust to effectively plunge China into recession. It doesn't really matter what the official numbers are telling you at the moment, because they're pretty much full of it. China, if you look at any kind of private sector real-time indexes, is already in recession. So the PMIs and other things are plunged deeply negative, and they're doing what they can to lift it, trying particularly hard with fiscal policy. But the nature of this bust in China is very different to those that have come before, both in terms of the virus and in terms of the property bust. Trying to build more stuff, infrastructure, when it doesn't really matter if you're trying to build more stuff if you've locked down, is the first point. Secondly, given the property bust is being exacerbated by the lockdowns, that has absolutely cratered land sales, which means much lower revenue for local governments, which means the fiscal attempt to stimulate is inhibited. The transmission of it to the real economy is not what it should be, because they don't have the money from falling land sales. And so
this is this pro-cyclicality we've spoken a lot about in China, where when land sales are going well, then local governments have lots of money, and so then they want to get out and spend. Whereas they're in the opposite now. Land sales are going really poorly, and the government and the central government's telling the local governments get out and spend more money, and they're sort of going, well, we don't have the money in the budget, and they know that people have lost their freedom. They can get sent to jail if you're an official who runs up too much debt and has problems in local areas. So they've got these two competing things going on, and nowhere really to get the money from.
Exactly. So China is in recession. Europe's approaching it, and that flips us over to the US, which of course has had the greatest of the inflation shocks coming out of the pandemic. We won't go into why, but it's a fact. That's triggered a very hawkish Federal Reserve, which has flipped from seeing the inflation as transitory to broadening and deepening, and he wants to snuff that out as soon as it can. So we have 25 or 50 in the last meet? I can't remember. Anyway, there's a series of 50 basis point hikes lined up at the Fed, certainly for June and July. And it wants to normalize rates as quickly as possible, front load the hikes, so that it can then kind of sit back and review once it's done that, to see, just to try and catch up, basically, because it's got caught so far behind inflation. So that's led to radical steepening in long end yields and mortgage rates. So the US housing market is starting to slow very fast, and of course we're seeing the big falls in the stock markets as well. And so this is where we come to the spillovers from what is a slowing US economy. If we're going to see this asset price bust in the US as rates rise, then, and that is what's underway in stocks, probably houses following, although it may not be so much price-based in housing because they've got relatively low inventory, but it would be more real economy stuff like building new houses. The spillovers will be, big trade shocks for China and Europe, which of course we've just been through. Both of them are, already in a pretty parlous state in terms of their domestic demand. So the last thing they need is their external demand to fall, which is what appears to be unfolding in the US. And so all of that leads to the question. Earnings have been incredibly strong last year and into this year. But with all of these shocks going at once and all of this extraordinary tightening happening at once, will earnings just normalize, or will they start to fall? Because we'll end up in a circumstance in the global economy where you have all of this tightening trying to kill inflation, even as the economy falls off a cliff, and you get into kind of classic recessionary cycle where you have very large inventories, for instance, in the US that could be destocked, trade shocks hitting the other economies, and before you know it, in that kind of environment, maybe the Fed triggers some kind of credit event as well in either credit markets at home or abroad, especially in emerging markets. And so you suddenly find yourself in a rather pro-cyclical feedback loop that will force down earnings, force them negative over the next 12 months. And so you're forced to ask the question, we've seen the multiple normalize, but if earnings are going to fall, what would be the appropriate multiple on that? It won't be 18, which is what they've fallen back to.
Yeah, and typically you'd see that when earnings are falling, you're back to sort of 13 times earnings, that type of those types of levels. So still considerably down on where we are. Plus you'd have to factor in the earnings.
Yeah.
Fall. The other thing to note as well in terms of the earnings is the last this sort of last batch of earnings has been very focused on the growth has been very focused in the energy sectors and resources. And that's an area where people don't pay high multiples. So keeping in mind as well that, if you're looking at your earnings and more of your earnings is coming from these sort of lower quality type of earnings, in terms of saying, yes, you've made a bucket load because oil prices were $120, but they're not $120 anymore. So therefore, I'm not going to pay, that much more for those types of earnings if we're expecting it to fall back.
I assume that's why the ASX 100 multiple has fallen much further.
Yeah, that's right. Yeah, the Aussie one looks lower. Yeah, exactly for that reason. It's a mixture of the iron ore and the coal plus
gas,
energy prices.
Yeah.
And so yes. So when you look at it on sort of excluding those factors, it doesn't look anywhere near as cheap. But so I guess it's that issue that you get with the Aussie markets, actually, because it's quite an extreme version. That the saying is for the resources side is you buy them when they're looking expensive and sell them when they look cheap. So the reverse of what you'd expect, and the reason why is because when stocks are on when energy stocks are say on 5 times their earnings, because the earnings are so inflated and everyone's expecting that earnings to fall off. It's not the time to be buying stocks when your earnings are going to halve or quarter. Whereas the time to be buying it is when actually they're low. Energy prices or commodity prices are low. Nobody's been doing any investment. Demand's starting to pick up, and so you might be buying some of these stocks on 20 or 30 times price to earnings because they're not earning not earning great profits. But then as the sales comes through, that really turbocharges them, and you get all that earnings growth coming through as well. So yeah, and I think there's a little bit of that at the headline level now. That's a little bit what you're seeing right throughout stocks in terms of that the earnings quality is not the same. It's much much better to have a new earnings dollar from a Microsoft or an Apple or someone like that you can sort of see where there's growth going forward, rather than another earnings dollar from having $120 oil price rather than $50 oil.
Hey guys, we've got a viewer question come through. viewers just asking, do you guys have any idea why gold's remaining quite subdued? And I guess that's in the context of, traditionally gold's sort of a safe haven asset in times of market uncertainty.
Real interest rates is the
answer. What do you mean by that?
Well, real interest rates plunged very deeply over the last couple of years during the pandemic. And
what David means by real interest rates is the interest rates after you take out the effect of inflation.
Yeah. And they went, typically gold will follow. If real interest rates are really negative, gold will go up. And if real interest rates are positive, then it tends to fall, because obviously gold isn't a yielding asset, and so it gets kind of pushed out when you get decent real interest rates that are offering yield. So basically, in the last couple of years, we've had very deep negative real interest rates, which has supported gold, but it never took off the way I expected it to, largely because I think Bitcoin stole a lot of its, or Bitcoin and crypto stole a lot of its fire. And now real interest rates are rising for the first time in quite a few years. And so gold's falling on that, as is crypto now. In fact, crypto is shaping as the possible event that shakeout event that triggers deeper falls in everything right now.
Yeah, it's interesting, that one, isn't it? I mean, that's this idea that we spoke over the years about it as crypto gets bigger and bigger. That we've got central banks relying on the wealth effect in terms of saying, yes, I'll keep my rates low in order that I can keep asset prices high, and the wealth effect from people feel from when their housing is more expensive and their housing is worth more and their share portfolio is worth more. It's interesting to think that wealth effect for crypto is starting to, given the volatility of it, is starting to hit levels that actually, if in theory, if your goal was to keep these asset prices high, you should actually be starting to keep an eye on crypto, because it's now starting to make such a large part of people's, certainly the millennials.
Mm-hmm. The other factor in gold is the US dollar. That's very central to the gold price, and it's at 20-year highs. So it's very difficult for gold to rally into that. In fact, it's very difficult for all commodities to rally into that. Though so far they've managed it on the back of, first, a bit of inflation, and second, Ukraine supply shock. But the further we get into this unfolding scenario that we've just described, the more likely the commodities are to eventually crash as well.
Okay, great. Thanks for that. And there's a couple more questions just coming through. So one question is saying that there's rumors that China's going to cut interest rates in the next couple of weeks. Is that going to make any difference to their economy, considering they're in lockdown as well?
It'll make a difference in that it'll accelerate the falls in the yuan. That'll certainly be constructive for the Chinese economy, but sadly it will be destructive for the global economy. In fact, a falling yuan is pretty apocalyptic for global markets, simply because the Chinese export machine is too large for it to be competitively devaluing, and so what it tends to do is just bleed out the entire emerging market complex. And it sends everybody else scurrying back into the US dollar, especially if the Fed's hiking. And obviously it makes domestic production of commodities cheaper, and pretty much the worst thing, for the way the global economy currently operates is a falling Chinese yuan. So this is why the Chinese have been so slow to cut rates, despite the fact that they're essentially in recession. They've even got a bit of an unemployment problem. And in previous cycles, they would most definitely have slashed rates by now. The reasons why, I think the main reason is, in fact, the yuan, because they're aware that there is actually the spectre of a crisis in this for them if they cut too deeply and capital outflow accelerates. and they could exhaust their forex reserves relatively quickly, and suddenly the yuan, free falls, and you get a kind of classic emerging markets external shock. So that's probably the main reason they haven't cut, but they may cut, or they'll cut repo, or they'll try new targeted cuts or reserve ratio. They're going to have to do all of these things, more of it. But no, I don't expect it to turn it around for the two reasons. The property bust is driven by macroprudential policy, not so it's actually the distribution of credit, not the price of credit. And that is called the 3 red lines policy, that is denuding developers of money, of credit rather. And so they can't build the way they used to. And because a lot of them are therefore going bust, there's all this counterparty risk for buyers, and they don't want to buy. And so you can't fix that by making credit cheaper. You actually have to do some more clever prudential policy, or give up on what you were doing, which was trying to force an adjustment on property. So that's the first part of it. The second part I mentioned, which is the falling CNY, has slowed them down. And the third part, of course, is Omicron, which just doesn't matter how cheap credit is if everybody's curled up under their doonas at home. So, it may make eventually a bit of difference, but even though, for instance, a lot of the lockdowns have come off in Shanghai, still going, but have eased, all the partial lockdowns that are everywhere haven't budged at all, because Omicron's just so contagious. The moment they kind of normalize mobility and people-to-people exchanges, it's just going to explode again. So as long as they got zero COVID, they're stuck. So in short, it's going to be very difficult for them to get any kind of robust recovery going.
The other issue is that they've got a bit of a different economy in the sense that the household share of their economy is basically the lowest in the world. And actually, I think I even saw someone suggesting it was lowest in some of developed country, so over like huge periods of time. And so what that means is that corporates and governments take a lot of, there's an economic pie. Corporates and governments take the biggest slices, and households aren't left with very much.
Yeah.
And so when you start cutting interest rates, what that does, as Dave spoke about, is that lowers the yuan, which is actually a negative for consumers and a positive for businesses. And so you're actually going to make it harder for them to come across, because people who are working now, their wages are lower, and so that's good for exporting things, but bad if they want to buy the latest iPhone or whatever it is. So that's one part. And then also that they're actually quite large household savers, and so you're actually decreasing the amount of interest available for them. And so there's a reasonable I guess if that's the way they're, and China, one of the things they do need to do is reallocate their economy towards more consumer spending and less business and government spending, and this is going the opposite direction, as a lot of their policies are. So if they're cutting rates, that's you're helping businesses, and a lot of their policies at the moment are about giving tax cuts and things like that to businesses, rather than helping out directly consumers, and that's why they're going to be stuck in this poor economic environment for the foreseeable future.
I will add that I think they'll bounce out of the current lockdowns and stuff a little. It will improve a bit, but there's just the current policy settings make it extremely difficult for them to get anywhere near their 5 point whatever growth target. I mean, and when I say nowhere near it, I mean half would be a great outcome.
Okay, excellent. Thanks for that, guys. Those are in-depth answers to those questions. I hope the viewers are satisfied. So yeah, I think we'll move on to the next slide now. I think we've got the Spanish flu analogy.
Yeah, so this one we've been pushing for a while as well, which is, this is the best kind of historical analogy that we think we have, which combines the deglobalization and pandemic, inflation shock, and a central bank response, all of the things that we've currently got going, and gives you a good feeling for what happens when you get a supply side inflation shock addressed with a demand side tool. You basically get a big accident, and that's kind of what we're seeing play out in the global economy now. And the upshot of it in 21-22 in the US was a depression, actually. Now, there are other factors involved, demobilization of labor and things like that after the war that increased the deflationary pressures. But, you've had like, what are we now? Like a couple of years of supply side inflation. Undoubtedly, there'll be lots of supply side response to that. That is increasing capacity. That's been disguised because the supply side shocks have kept coming. But if you get a demand hiccup, then all those responses to that supply side tension will come through, and you'll go from a situation of extreme supply side tension to supreme supply side slack. And that chart there is a good example of what happens when you do that. Basically, prices just crater. And what was inflationary turns dramatically deflationary. So if we get, if this runs on long enough with the Fed tightening pro-cyclically because its inflation is worse than everywhere else, and its financial conditions index that we've showed you some earlier is actually still very expansionary there. So they need to tighten just to get that into slowing territory. Then we run the risk of doing this globally. That may not happen. Fed might wake up. Markets might crash enough to force the Fed backwards. There's still a soft landing case that's reasonably strong. But this is where we're going at the moment. And the Spanish flu analogy is a pretty good one. So if the Fed is forced to keep hiking pro-cyclically into a global bust, then we get 2023, 24 is pretty deflationary years, and that would include commodities, I might add. I'd expect them both to crash too.
Right, we might wind up, Sam.
Okay, so in a moment we've got our viewer question, but I just want to take a moment to showcase our new direct indexing products, as they're the first of the kind in Australia. So direct indexing, it's similar to an ETF, as it's a buy and hold passive strategy that tracks an index. But the main difference is it allows you to customize your holdings in that index, so you can tailor it to fit your personal ethical values and beliefs. Whereas a traditional ETF, it's a one-size-fits-all that can't change. So with direct indexing, you own all the stocks directly, and you can customize the index by utilizing any of our ethical, sector, and asset class screens. And we have around about 50 of them to choose from. So just to give you an example, you can exclude Australian banks from the Australian leaders, for example, or you can exclude coal stocks or add more technology stocks. So you really have the ability to customize your portfolio however you see fit. So if you want to see some more information, please go to our website at nucleuswealth.com/direct indexing, and you can have a look at a bit more information there. So now we've got our question of the week. So this is for viewers to have some discussion in the comments section over the coming days. The question for this week is right now a buying opportunity, or are we too conservative? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So yeah, Damien, I'll hand it back to you for the investment implications.
Yeah, sure. So I think what have we got here? The main issue is in the end comes down to interest rates, and the question, if we think about it as a sort of a pendulum around sort of the fair value, is we think it's swung way too high. We're talking about another sort of 3% ish in terms of interest rate rises in Australia and elsewhere around the globe. That's already starting to hit asset markets, already starting to hit demand. And so effectively what we have here is a Fed who's decided, and other central banks as well, sort of following the Fed, have basically decided to smash demand in order to bring it down to meet the supply side problems we're having. And as sort of some of those charts showed, there's a reasonable chance of recession if they don't change their they don't change the path we're on at the moment. And given how fast things have been moving, we're expecting that to happen sooner rather than later. So in terms of stocks, we've been underweight stocks for some time, and that's obviously been the right call so far. We don't think it's time yet to be jumping in. Maybe if you had a very long time frame and you didn't mind sort of riding out some more downside volatility, you might want to start sort of chipping away at stocks at the moment. We're sort of happier just to hold on a little bit longer before we start easing into buying a few more stocks. And we also think at the same time, we're holding a bit in the bonds portfolio and starting to build that up a little bit. I think our expectation is that the bond yields will come off, and that'll give us an opportunity to switch out of those bonds into stocks at some point in the future. That's the game plan at the moment, but it's sort of obviously evolving quite quickly.
Yeah, that's a very important point. I think that a lot of people are underestimating is the sheer speed of this cycle. Like, we've been shocked time and again by the speed of it. Things that we thought would take 2 years took 2 months. Markets inflated, all crash down, crash up, and blue bubbles popped, all, at a fantastic rate of knots. And so, kind of looking out to 23, 24, wondering if there's going to be a slowdown, we think is really kind of besides the point. It's much speedier this cycle than that. And I'll just simply add to that, I think the speed of the cycle is because of COVID and the stimulus response. But on top of that, we're all, the entire developed world is so financialized now that raising rates and reducing fiscal expenditure at the speed it's being done just has incredibly swift transmission now through to the real economy, much faster than it used to, I think. And, because asset prices are no longer representative of productivity or economic gains, they drive the cycle instead via credit issuance. And so a lot of your financial conditions tightening these days happens via asset prices that move quicker and affect demand more quickly. So that's it for me.
Nice one, guys. Thank you very much. That almost wraps us up. So Damien and Dave, just want to thank you guys for sharing your insights and knowledge as always.
Pleasure. Thank you.
Awesome. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it into the comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial situation, please go to our website at nucleuswealth.com and book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can follow us on all major social media. So from myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.
Bye-bye.
Thanks, guys.